Welcome to another episode of the Financial Armor Show. My name is Jose Rodriguez, investment advisor here at Cooper Financial, and your host for today, alongside my co host, Tony Shore. How's it going, Tony?
Oh, it is going great, Jose. I've had a great week. Can't complain. Mother's Day was last weekend or a little bit ago, depending on when you're listening or watching the show. But spent the day with my mom. That was
Very
so
nice.
much fun. My kids and I went and saw my mom and dad and got to spend the day, take my mom out to eat. She doesn't get out as much, so that was fun. And
Very nice.
then the kids came over on Sunday and spent the day, our kids, with my wife, Sarah. So we had a great weekend. The weather was good. How about you, Jose? What have you been up to? Keeping busy?
Yeah, I've been keeping busy. It's starting to finally slow down. We're past tax season,
That's
so
good.
it's been great. And then the craziness in the news is starting to slow down a little bit. So
Yeah,
it's been a little bit better, more calm now. and
that's
as
good.
far as Mother's Days goes, I unfortunately my mom, I mentioned her in the past in the show. She's currently retired and she moved back to Mexico actually.
Oh, yeah,
And
that's right.
so I'm not with her physically, but I paid for the service for somebody to deliver a huge bouquet of flowers, and it
Nice.
was great. So they got to spend time with a bunch of family over there. So was I not just got to watch them on video and pictures.
Oh, good.
But other than that, that was my weekend. Not a whole lot. I'm still moving in, so
Oh, that's
trying to
right.
get
You
that all sorted out.
got a new place. I've got to come check that out. When you have a housewarming party, I assume I'm going to be invited, right?
Yes, yes, I'll pay for your plane ticket too.
Oh, no, you don't have to do that. You
I'm
don't
just
have to do that. Well, we have, for our viewers, they can already see that we're going to have a very special show today because
Yes.
we have an amazing special guest. Jose, you have the connections. You get the A-listers. I love this. The most awesome guest. So introduce our guest for today's show.
Yes. So today we have a very special guest. We have Professor Susan Tang here. And let me tell you a little bit about her. Her background, she has a PhD in economics from Georgia State University. And her research entails intersection between public, environmental, and behavioral economics. She
Wow.
was recognized on the Dean's List for teaching impact at the Arizona State University, which is the university that I went to. And as you could see, uh, she was my former professor, and that's
Oh,
why she's
awesome.
here. So she was one of the biggest reasons why I just became obsessed with the topic of economics, and that's why here on the show we talk about economics a lot. Ever since that I came in, I feel like I'm just pushing that topic all the time, just because I'm passionate about it, right? And she taught me everything that I need to know, or not that I need to know, but everything that I know on monetary policy and banking. In other words, she taught me everything that I know about about the way that money moves in and out of the economy. So, Professor Tang, thank you so much for being here.
It's my great pleasure to be here. Thank you for inviting me, and thank you for the introduction too. It's a great pleasure to hear how that helps you and how sometimes we feel some classroom knowledge actually transfer to some
Right?
meaningful insights, and that's such a pleasure. Yeah,
Thank you.
for the
That's awesome.
invitation.
Very good. So let's just dive right in. So the Federal Reserve has decided to keep interest rates unchanged, right? But as I'm watching the news, CNBC and other investment analysts, they are all, for the most part, talking about uh, 25 basis points cuts by the end of the year. Now, even today, there's been an update. And tomorrow, there's going to be even more of an update with the CPI numbers coming out tomorrow.
Yeah.
So it's an ongoing change. And as of today, what's today? May 12th. So this information that we're going to talk about is as of current as of today, May 12th.
Sure.
So how realistic do you really think it is that we're going to see 3 interest rate cuts of 25 basis points by the end of the year?
Yeah, I think that's a very interesting phenomenon. It's a kind of a forecast many would say the one of the main issue behind it is the dilemma we have between the inflation and the unemployment. As many of the listeners, I would say, already know, probably Federal Reserve have a dual mandate to prefer a low inflation rate, and the long-term target is 2%, and also low employment. But currently, we know tariff is a huge uncertainty to everyone, to investors, to our customers, consumers, also to the Fed. So Federal Reserve prefer to kind of wait and see how our data shows the impacts from our tariff. And as of today, we know we have more kind of real numbers. China and the United States kind of settling for 10% along with another 20% for the tariff, and at least for the next 90 days. That's for sure, and that's great news.
Yeah. That's news as of today, May 12th.
That's right.
Yeah,
just this morning, and it's perfect. It's much better than the expectation. To be honest, it's much lower than that, and we can see the stock market is going crazily, and 4% for the Nasdaq. Yeah. So overall, when we have more certainty on the numbers on the tariff, and when we have more solid data from our economy, then Federal Reserve kind of have a better picture of how many cuts they're going to have. But for at least for now, the next 2 meetings, probably no cuts. June, July, the rate cut is very low because our current economy is very in a relatively good and steady condition, with good inflation number and unemployment numbers. So yeah, probably not much about rate cuts to stimulate the economy, at least for the next 2 meetings. But the last 3 meetings for this year, some people expect 3 cuts and some expect at least 2. I would say at least 2. That's something probably very realistic.
And a quarter of a basis points, do you think would be also a fair expectation?
Yes, like a 2 quarter points. Yeah.
Okay. Very good. And so, and just because tomorrow there's going to be some more data being posted, and right now you're in agreement that maybe 2, most likely 2, possibly 3, right? But what would change your opinion? Let's say tomorrow the new number comes out for CPI, right? What would that look like? What would the CPI have to look like for you to change your opinion?
Yeah, for Federal Reserve to cut the rate, we prefer a situation that the inflation is low. Is, for example, if it's already 2%. If tomorrow we see the inflation is 2%, that's great news for everyone, and that gives Federal Reserve more confidence to cut the rates because we feel like that's getting close to our long-term target. At the same time, cutting rates, the goal is to stimulate the economy to make the borrowing cost to be lower. Probably for people who invest and people who, let's say, purchase a home or loan a car. So for both investors and consumers, the rate is lower and we can stimulate the economy and they're going to do more investment and consumption. So if we do see our economy is heading towards kind of like a recession, for example, our job report data, I think it's just come out maybe 10 days ago, 10 or 1 week ago. It's better than our expectation, actually.
Right.
And that's good for the economy, but that's a negative signal for the Fed to cut the rate. And they don't see the necessity. They don't see the need of cutting the rate at all to stimulate. So that would be something to kind of to hold Federal Reserve back. But if our inflation rate is good and after we see a higher and higher unemployment rate and our GDP probably is also heading down for solid reasons, and Federal Reserve will do more actions. But currently, you can get a tone from our Fed chair, and also the officials. They kind of want to wait and see. They want more data. They want more certainty. Yeah.
Right, and there has been a lot of uncertainty, I guess, even with the talks between the president and the Fed and Jerome Powell, the Fed chair, where he wants the Federal Reserve to cut interest rates ASAP, right? But and when I wrote my points that I was going to talk about, we didn't have the news of they're going to pause the suspend the tariffs. But one of my questions that I had, which it was burning in my head, was what if Jerome Powell actually gives in and, let's say, cuts interest rates, and the tariffs happen to come back maybe, or even stay where they were in the past. But let's say they come back and interest rates are cut. Wouldn't that put us in a situation where technically inflation would come back up because of the tariffs and GDP would come down?
That's right.
Right? I paid attention in class, guys. Okay, everyone listen.
That's right. What's the term
so with
for
that? So with that backdrop, what would you call that? And that's what do you call that then? As when inflation increases and GDP drops?
That's like, to be honest, a worse situation, and
Exactly.
we are paying a lot for our daily life, and at the same time, many people lose their jobs. So, in high inflation and also high unemployment rate, and we see a stagflation. Economy is stagnant and also face some inflation. For Federal Reserve, that's also a dilemma. I think our chair also mentioned this dilemma in the previous meeting. In that case, if we want to cut the rate, that would be great for the unemployment kind of firms. They have lower borrowing costs and they can hire more people, and the unemployment rate can potentially decrease. But at the same time, that's bad news for inflation. That could push up the inflation rate even higher.
Right.
But if we don't cut the interest rate, or even on the other hand, if we raise up our interest rate, that would be great for the inflation. We put it down, but our unemployment rate would be even worse. So that's a huge dilemma if that's the case. And tariff definitely put a great risk.
Right.
It's like a balancing act is what you're describing. The poor Fed has two mandates and they're at odds with each other based on what they do. They have some levers they can pull, like interest rates. But if they lower them, that can help the jobs market. But if they raise them, that hurts inflation or raises inflation. So, yeah, it's kind of a double-edged sword, isn't it?
Definitely. So that's a very hard situation, and it's they have to make a choice in that case. Do they want to deal with the inflation issue first, or just the job markets or unemployment issue first? But there's no easy or no best solution to that at all. So today, this morning, we see the tariff is much lower. That's great news, and also give definitely Federal Reserve more confidence in the following moves.
Right. Yeah. And we got some great news today, as the market knows, and the investors are getting a little more confidence as of today. And now that we brought even the balancing act of the dual mandate, and Tony, I mean, I don't want to get too technical, but there's technically only three things that the Federal Reserve can do, right? As far as what they control is the interest rates, discount rate, open market operations where they buy and sell securities, and regulation of the what do you call it, what they keep in the banks, regulation to keep on cash.
Yeah,
right.
That's amazing. Jose, you did a good job.
So with that though, have you seen anything using those three tools that the Federal Reserve has already started to essentially put more money into the world in other ways other than interest rates?
That's a very solid question, I would say, because many times we talk about Federal Reserve, we just say the rate. It's a federal funds rate, and usually there's a target. It's a range. For example, it's 4.25 to 4.5%. That's the current rate. But how do we achieve that target? Federal Reserve actually cannot directly control it. That's a rate commercial banks borrow from each other. It's an overnight loan. So Federal Reserve use the tools you just mentioned to affect that rate, to achieve that rate. And so far nowadays, some of the most widely used one, including the open market operations, as you just said, or discount rates, and also interest rate on reserve balances. So if banks hold their cash, Federal Reserve actually pay them interest to as an incentive for them to hold some cash. So those tools work together to put that target. But those tools, the goal of using them is to achieve the target federal funds rate, the rate we kind of all the news we are talking about. So far, at least from their previous meeting briefings, I don't see they're making huge changes or making big moves of using those tools, because they still keep the federal funds rate steady, keep the federal funds constant. But there's another tool Federal Reserve use nowadays. It's kind of subtle. It's called the forward guidance. It's more like from the lines to lines, sentences, the wording tone of our Fed chair, and investors kind of guess, and where are we heading at? And that's also what the Fed want us to read from the tone.
Right.
So they're using it also right now, and the tone is wait and see, but we will have more data in the next meeting, definitely.
So you're saying the Federal Reserve uses language and tone in messaging, especially with media and social media, and they can get the messaging out there and actually sway economics and the balance of things just by their tone and their language, right?
The tone definitely play a important role, and you can see we investors read from the wordings. Is it more harsh of the Federal Reserve talking about this situation, or it's more like or it's more towards a gentle, or sometimes, for example, Federal Reserve talk about we are very concerned of our current situation, and that's kind of a harsh signal. It's called a hawkish, like a hawk, to investors, and showing that we probably don't want to reduce the rate so quickly. But if we read it, like we can definitely do something, or I'm not sure about the exact words, but the tone itself also play an important role, definitely.
Yeah, it's like a cryptic. You have to. I know people, especially on the news cycle, that print out exactly the transcripts of what he said and just trying to. It's almost like reading code.
They
analyze.
Yes, it's very interesting.
Yeah, I know at the investment firm, Gradient Investments, their portfolio managers really look at what the Fed. If the Fed comes out and says, we're really we are happy. They don't usually use the word, but if they say we're really content with where things are at, or we think things are headed in the right direction, if they use those terms like right or content or happy, versus concern. We're really watching this closely. We're concerned about it, like you said. Yeah, people analyze every word. I mean, if Chairman Powell goes out for lunch, what did he order? Is he in a good mood? How can we tell?
Even the tie that he wears influences. I've seen people talk about that.
Yeah.
Crazy how much influence one person can have.
I know.
People are eager to read more information from it. Definitely.
Yes, they read into it. Yeah.
I have one more question regarding this Jerome Powell here. So let's fast forward, and this 90-day period is over, and let's just what would need to happen for the Federal Reserve to think, yeah, maybe we should increase interest rates, as far as with the tariff situation, because I feel like that's we're always waiting for what's the next thing in tariffs. And that's why a lot of people were concerned about interest rates possibly coming up. I know that that's one of our clients' concerns of inflation. I'm sorry, on the interest rates coming back up.
Yeah. After 90 days, it's August, right? So it's before the September meeting. I would say back then, if we have our inflation rate coming up again, and it's pretty high, let's say like a 4%. I know that's very high, but 4% is already very high. At the same time, our economy is so resilient, and we don't see high unemployment rate. And there's a small chance, I would say, the interest rate probably go up again. but the probability is so low, because if we do increase the interest rate again, that's not just another increase in the interest rate, and people would expect we're in a whole cycle of increasing the interest rate. So it's not just one-time thing, and we're in a whole cycle. And Federal Reserve know that. That sends a strong signal to investors that the interest rate is not coming down, instead it's going up. So I personally would say that's a very small chance of interest rate hiking. If that hopefully provide some comforts to our investors. On the other hand, interest rate do have a good chance. I would say a pretty good chance. Maybe on the September one, higher than 80% of chance of going down.
Okay.
So
very good.
In that case, we probably see the inflation rate heading down continually. Currently, it's 2.4% and down from 2.8% in February. So if we have more data, for the April, for the May, during the summertime, inflation rate is heading steadily towards 2%. And that sends a good, strong economic signal to Federal Reserve, and they have the confidence to reduce the interest rate. And at the same time, because of the tariff, because even though it's lower than our expectation, it's still there. And also it poses actually still consumers and investors feel some uncertainty from our economic policies. So in that case, if we see the job market is in a bad situation, for example, our job created is not as good as our expectation, unemployment rate is high, now is around 2%. If it's higher than 5%, let's say, in the GDP, and then we have the data for the first half year of our GDP data. If GDP is also heading down, then definitely we will cut the rate. But even we don't see good drop in the GDP rate or in the inflation rate, but the rate cut is still kind of in their picture. I would say it's, at least for the September's rate cut, is a pretty high chance thing.
Well, there you go. Now everyone knows when. I mean, I agree with everything you said as far as when I was expecting interest rates to start coming down too. So I think that's great, and I'm sure listeners are very happy to know that there's a higher likelihood of coming down than the likelihood of coming up. So,
definitely much higher.
Yes. So another concern that our clients have brought up to me from phone calls and reviews that I have done with people, they are concerned about digital currency and that it could replace the dollar. Right now, have you seen any signs of that happening currently?
Short answer is no. So you you don't have to worry about crypto or digital currencies replace dollars. Dollar is very strong, and the position is there. I don't see much happening. We only have one country in the whole world actually adopts cryptocurrency as their own currencies, but it's a South American country called Saudi.
Salvador. Or which one is it? I'm sorry.
Yeah. Go
Salvador?
ahead, pronounce it.
It's Salvador. Yes. Yeah, Salvador. Yeah.
My pronunciation is also
no, yeah, but that didn't work out very well, did it?
Not really.
Yes, that's what I thought. Yeah.
It has some benefits, but the main issue is crypto currencies have huge volatility. Huge volatility. That's kind of out of government's control and out of any world organization's control. And that volatility make it sometimes a good investment opportunity, but also a bad currency, or at least for trading purposes, it's not a very good tool. So far, not many central banks even hold many cryptocurrencies at their reserves. Dollars is still the strongest. Yes.
Right.
So that's.
Yes. So and then another, not just digital currency, but now people are bringing up gold as hey, and and I remember talking about this during class too. But eventually, a lot of people have talked about bringing gold back. But it's such I think it's a very complicated topic to talk about. But it's essentially, why is going back to the gold not a good idea?
The gold
Uh,
standard.
The
It
gold
used to be
standard. Sorry.
called.
Gold
Yes.
Yep.
standard. Yeah. For all those, I would say gold is also a great safe asset for us to invest, and especially currently we face a lot of uncertainties from U.S. and U.S. policies, and many investors choose to, turn to gold for the investment instead of a U.S. or the bonds, treasuries. So gold is a good asset for investment, and especially safe assets. But I would say it will cause huge confusion if we go back to gold standard. The dollars, it have both the investment purpose, if we can save dollars, and we know it's a relatively safe asset, but it also serve as a trade purpose. And
Right.
when we buy and sell stuff, and it facilitates the trade, and it's build up the convenience for the medium of exchange. So for that part, dollars, I would say, would always be, not always, I can't say that for granted, but for quite a long time, we would go with dollars. Gold itself, especially in this year, is a great safe asset to invest. Even for many central banks in different countries, they actually buy a lot of gold. Usually they buy a lot of U.S. bonds and U.S. assets. Nowadays, gold is like a new favorite, not really favorite, but they tend to purchase more to combat with our uncertainties. So overall, good asset for investment, but not for trading.
Right. And when you say for trading, that's my opinion of gold too. We've seen it do really well, but I have to weigh in on this because I always I always laugh when, there are a lot of preppers or doomsday sayers when the economy gets bad like this, or tariffs, or there's turmoil between major powers like US and China and Russia and wars. People say, I'm going to have all gold, and they actually want physical gold. And I'm like, what if the dollar collapses? I'll have gold. Are you going to go down and shave off a piece of your gold? Are you going to have to use some kind of metal hacksaw to hack off a chip of gold to buy a loaf of bread? Or is it going to take a gold bar? I mean, if dollars can't buy a loaf of bread, I don't know how a gold can buy a loaf of bread. You know what I mean? Like you say, for
Definitely.
trade, if you want to trade gold for food or for transportation, I think it gets a little trickier because we've established the monetary trade system, and it doesn't include gold at this point.
Yeah, that's right. So
Right.
that bring up actually a very interesting concept for those assets. It's called liquidity. So how easy you can convert it to, for example, dollars, which you can actually use and then buy stuff. For
Yeah.
gold, relatively good liquid, and so you can easily sell it and people can buy it. But the thing is, itself, if you go to Walmart, they don't accept it, even though it
Right.
looks good, it looks amazing.
Yeah.
Yes. Very nice. And on the dollar, so far, majority of the world banks hold about 60% of the current of their currency in dollars, right? Which means that they have a lot of confidence in the dollar. And do you see that changing, that number decreasing? Because another concern that people are bringing up is BRICS. That BRICS is gonna shake up the trading world so much, and essentially debase the dollar, take it out of commission, and use another currency. But what I always say is, hey, look at what all the world banks have, and
Yeah.
majority of them still have over 60% of the currency in dollars. That should say something to most
Yeah.
people. And but do you see that changing?
For the US dollars, the percentage of central banks holding it as their reserve is very high, 6%. Is gradually declining over the years, just a slight trend. It's nothing extreme or nothing going down crazily. So I think before, for example, 2005, I don't remember the exact numbers. The rate, for example, at the global reserves currency is over 60%. And then this number gradually coming down, and in the recent years, it's below 60%. I think before that, it's even higher than 65%. So this shows a overall trend. Dollars have been the dominant currency for a long time, and it will be a dominant currency for also for a very long time. But it will not be the only one. We have, for example, euros. People or central banks hold it, and nowadays gold is something we like to, because it's relatively safe and it's regardless of the geopolitical issues. For example, in the United States, it's a relatively safer, even a safer asset. But overall, US dollar have been a very strong and a dominant currency over the world. For many countries, including the BRICS, as you mentioned, they will probably adopt their own system, but that would not have a huge impact on the US dollar as the main currency. This is the trend. It's a slight declining over the years, but it's still over 50%.
Yes, and I'm gonna, just to close out, because I know we're running out of time. My opinion, and I think it's probably accepted in the economics world. The reason that is probably is that the world banks are diversifying their currency, because over the last couple of decades, the overall world has become a little more connected. So having a little bit of euro, a little bit of the pound, having that as a reserve helps with the globalization of trade. So I don't think it's necessarily a bad sign of the overall reserve coming down. It's just a sign that the world is becoming more connected. So I don't think it's again, I agree with you. It's not I'm not concerned about it either.
Great. Diversification. I agree with that.
Yes, exactly. Tony, do you have anything else to add?
No, I think this is great. You made a lot of great points, Dr. Tang, and I think it's great that you were willing to come on the show and share your knowledge with us and your views with your doctorate and your studies in economics. And I know I've listened to Jose go on and on about what he's learned from you and from the class and things like that. So it's fascinating to talk with someone like yourself. Thanks so much for coming on the show. I think it's great, Jose.
Awesome. Yeah, again, I appreciate you coming out and joining us. Hopefully in the future we get to have you again. I don't know, maybe something interesting happens, and then having you back would be an amazing opportunity as well.
I would love to. It's my great pleasure. I would love to. And Jose is a very talented and great guy, and you did a great job, and this is meaningful, and you're impacting a lot of people. So this is great. This show is great, and I really appreciate it. Yeah.
Thank you.
Oh, thanks. Yeah, Jose does a great job. Well, I'll tell you what, this is great. Jose, before we go, let our listeners know how they can get a hold of you if they have any questions about finances. Maybe they're concerned about where things are headed. You can help them come up with a plan so they can sleep well at night. Don't need to panic about finances. Don't let the news scare you, right?
Right. If something does come up, maybe a thought comes up, bring it up to us, and then we'll answer your questions. If any of your listeners want to get a hold of us and schedule a no cost appointments, you can get a hold of us at 888-390-5277, or go to our website, financialarmorshow.com, and schedule that appointment.
All right. Again, that number, 888-390-5277. And the web address, thanks for that, Jose, is financialarmorshow.com. And that does it for today's episode of the Financial Armor Show with our host, Jose Rodriguez, and our special guest today, Dr. Tang.